This is Scott Whitwam with your morning real estate investor update. And today's top story, the U.S. has experienced the lowest real estate turnover rate in the last 30 years. A healthy real estate market would see about a 4% home turnover rate in any given year. This year has yielded about 2.5% turnover according to Redfin. It may be an underestimate to claim that the housing market has been stuck in 2024. Americans have been facing an onslaught of economic issues, including record high home prices, elevated mortgage rates, and high levels of inflation. This had created one of the most unaffordable housing markets in generations. The recent Fed rate cut has done more to install hope in the housing market, but add little to the economic value to this point. Continued low inventory levels is doing little to help turn around the disappointing housing market. In today's mortgage rate update, the 30-year fixed rate mortgage has seen unexpected movement following the release of the September jobs report. What looked like good news on the face turned out to be superficial. Since then, the 30-year fixed mortgage rate has seen the largest one-week increase since April. However, the rise in rates may be equally due to shifts in expectations as much as underlying economy. After the Fed cut the base rate in September, rates hit a 24-month low. Unfortunately, much of the decrease has been given back. Freddie Mac is reporting that their national weekend average for the 30-year fixed-rate mortgage was at 6.32%. This is up from the previous week average of 6.12%, and the 15-year showed similar movement, ending the week at 5.41%, up from 5.25%. In today's wrap-up, inflation creeps up. In September, the Consumer Price Index was 3.3%, higher than a year ago. That's a pretty good jump. This is a move in the wrong direction, for the Federal Reserve has been laser focused on this inflationary number. There is considerable speculation that the Fed may have cut the base rate too significantly in September, and that the timing of the cut was suspect close to a significant general election. Of significant note was a rise in the housing costs, which increased by 4.9%, higher than a year ago, and continues to be a principal reason why inflation remains painfully high. But housing wasn't alone. Other categories that posted large monthly increases included medical services, clothing, and used car prices. Consumer sale prices and housing start numbers should be available this week ahead of the next Fed meeting. Be sure to subscribe to the Morning Real Estate Investor Update and join me on the weekly Whitwam Wealth Real Estate Podcast.